All eyes on the 10-year again, and we saw it trading as low as 4.13 just 24 hours ago, up above 423 today, and that's after touching 4.5% about 3 weeks ago. And as a result of falling rates, though, from last week, the 30-year mortgage rate is now 676, down from 681 last week. But yields up today following reports that the U.S. economy fell into contraction in the first quarter. Those were the inflation readings for March, and then this morning, ISM manufacturing data showed a decline in April for the second straight month, came in at 48.7 below 50, which indicates that the manufacturing sector is contracting, but the decline was not as much as expected. Also, that comes despite a jump in weekly jobless claims that the Labor Department reported this morning. Last week saw initial unemployment claims increase to 241,000. The expectation was 225,000. So all eyes now focused on tomorrow's April non-farm payrolls report as other economic data has continued to sour. But then there's also the 2-year yield. And the 2-year is moving in tandem with the 10-year, up about 4 basis points on the day, sitting there at 3.67. And the policy-sensitive 2-year note was up more than 4 basis points after being lower this morning. But with the 2-year below the Fed funds rate, many are calling for the Fed to possibly lower rates sooner rather than later. And speaking of the Fed and what they may or may not do, looking at the CME FedWatch tool, and the Fed meets next week, the CME FedWatch tool pricing in a 95% probability of no rate cut next week, but then we see nearly a 60% probability of at least a 25 basis point cut in June. Additional cuts also priced in for July and September, and possibly another one at the end of the year. So from now until the rest of the year, a total of between 75 and 100 basis point cuts are priced into the market.